It's Adrienne Lau here with Remax. That's the live stream where I forgot to add myself to it. I am here today to talk about tax assessments. Stay with me. It's super boring. Wake up. This is why it's important, because you are paying hundreds, thousands of dollars every year in property taxes on your house. We want to make sure they're right, because if they're wrong, you could be overpaying, which means you could have the money to buy a trampoline for your children, which means that you would have time for peace and quiet in your house, which will add years to your life. So bear with me. It's not as boring as it seems. All right, so recently you would have just gotten, all homeowners in Michigan, whether your investment properties or your home, you get this bill. It says this is not a tax bill, at which point most people say great and they recycle it. But I don't want you to do that, because it's very important. So I'm going to dig in today and explain a little bit about it and how to look at it. So this is the new assessment that I got on one of my properties that we own in Lansing. And you can see here that it has the taxable value from last year and the taxable value for this year, as well as the assessments. And you can see that these numbers are very disparate. The reason is that we've owned this house a long time. So after you've owned a house, even though the assessment might be moving up, and that assessment is supposed to be half of true cash value on the property, the taxable value won't move up faster than the rate of inflation. So that's great. It means, hey, our taxes are only going up $35 this year, so that's great. However, if you just bought your house this year, you might see that that number is going up dramatically. And let me explain the reason why and what you might be able to do about that. So if you just bought your house in 2020, the first year that you own the house, the property taxes do this thing called uncapping. It means that all of a sudden the taxable value and the assessment are the same amount. So if the previous owner had been there a little while, you're no longer going to be at their lower tax rate. Now the taxes have come up. So I want you to take a look at it. And if your taxable or your assessed value is more than what you think half of the value is, I don't know why they do it this way. It's so confusing, but let's use some real numbers. Let's say you think your house is worth $200,000. If your assessment is more than $100,000, then I want you to take this time to think about going to your assessor and your local taxing authority and saying, hey, I think you've got me overassessed, and this is why. Give them the information about why you think you're overassessed. If you need some help with that, we'd be happy to dig in and pull up some comparables from your neighborhood. But let me stress why this is super, super important. The reason is that the first year you own the house, you're setting the baseline for all future years, because remember, you can't go up faster than the rate of inflation. So in a market like this, we went up 9.8% last year. I would much rather have the lower inflation rate. Not that it's always going to be that way, but right now it is. So I know it's a confusing topic, and the majority of us would rather just throw it away and not have to think about it. It's an important topic too, because you are setting the stage for your future tax bills. So please reach out if we can be of help as you look through that and understand it. And one final note, if you have an escrow account and your taxes are going up by, say, $1,200 a year because maybe you just bought it, you're going to want to start making an extra $100 a month payment into your escrow, or you're going to have a shortfall next year. So either know that or start setting the money aside for the shortfall. So hopefully that's helpful, and let me know if you have any other questions.